Okay, so in the last video we talked about checking accounts and how to write a check, how to endorse a check, all that good stuff. And now we're going to talk about reconciling the bank statement. And basically what this means is we want to make sure that the cash that we have in our account, in our general ledger, matches what the bank account is showing. So by comparing the checkbook to the bank book is called reconciliation. So we're going to reconcile the bank statement. So the bank sends us a bank statement at the end of the month, and we look at that bank statement and compare it to our own records to make sure that everything is accurate. So this section is going to explain how to prove cash and create bank reconciliation statements. Okay, so proving cash. At times the balance of cash, let me zoom in a little bit here, there you go. At times the balance of cash as shown in the cash account and the checkbook stub does not agree with the balance appearing on the statements rendered by the bank. So sometimes what we have on our personal records might not match what the bank has, and there can be several reasons for this, which we'll discuss here in a little bit. So generally the cash in the bank account balance should agree with the checkbook balance if all of the cash receipts have been deposited, cash payments have been made by check, and transactions have been journalized and posted. So comparing the cash and bank account balance with the checkbook balance is called proving cash. When we're comparing our cash and bank account with the balance of our checkbook, that's called proving cash. Comparing these two cash balances regularly is part of the internal control of cash. So we talked about internal control in the last video. Business persons prove cash daily, weekly, or even monthly. Okay, proving cash. So if it doesn't add up, then we have to figure out where we went wrong or identify the errors. If the cash and bank balance does not agree with the checkbook balance, then the trial balance indicates that there is a possible error in the checkbook. So this could be due to incorrect addition or subtraction. Maybe there was just no record made for the deposit of a cash or a check, or maybe there was a mistake in the balance that was carried forward to the next page. So we need to correct this error in the checkbook by using the next unused check stub. The following example explains this concept. So say we have check number 40 for $202, and it was accidentally recorded in the check stub as $102. So the next unused check stub is 58. So this happened on check number 40, and we realized it a little later. Now we're on check stub 58, and so we record the correction for that transaction. So we would look at 202 minus 102. That means we have a $100 difference there. And so then that adjustment is made and the balance is brought forward onto this new check stub. Okay, so that kind of updates our balance and what it should be. So then we need to go back to check stub number 40 and indicate that the error has been corrected on check stub number 58. Okay, bank statements and imaged checks. So the bank statement is the copy of all transactions issued by the bank to the depositor. So it's the sheet of paper that the bank sends you saying, okay, here's what we have for your balance, here's what's been deposited into your account, here's what's been withdrawn from your account, and that's what we have for your records. So that's what we need to take and compare it to our checkbook or our cash account. This statement provides information on all transactions in the depositor's account for a given period. So usually, like I said, it's a month. And the bank statement should be filed for proof in the future period. So the balance at the beginning, so the bank statement includes the balance at the beginning of the period on the checking account, a list of all deposits, a list of all checks on which payments were made, and the balance at the end of the month. So again, it shows us the balance at the beginning of the month, anything that came into the account, so deposits, and anything that went out of the account, such as payments, and then it shows you the balance at the end of the month. Imaged checks. So along with your bank statement, the bank may send canceled checks back to you. And a canceled check just means that is a check that has been paid. So if you wrote a check and that person deposited the check, the bank might copy an image of that check and send it back to you saying, okay, this check's been cashed and now it's been canceled, so it cannot be cashed again. So instead of sending actual checks, many banks send images of the original checks called image checks or substitute checks. So instead of sending you, they used to send you the check back, but now they just kind of make a duplicate of it or imaged or a substitute check and send you that image back. Okay, a bank reconciliation statement is prepared to reconcile cash in Vcash and bank account. So with the checkbook balance or a particular date. So again, we're looking at the bank statement versus the checkbook balance. And it lists the causes of differences between the cash and bank account and the checkbook balance. So there are three major causes for reconciliation. So these are the things we're going to look for. We're going to look for any outstanding checks, meaning checks that we've written that haven't been cashed yet. Any outstanding deposits, so any deposits we've made that maybe haven't been recorded by the bank yet. And any bank service charges. So again, outstanding checks are checks that we issued but have not been presented for payment. So maybe whoever we wrote the check to hadn't cashed it yet. We're also looking for outstanding deposits that have been made. The bank account, the entry is only made and the banker actually collects and credits the depositor's account. So maybe we've deposited a check but it hasn't been recorded on our bank statement yet because the funds haven't been collected yet. And we're also looking for bank service charges, or maybe kind of the fee for having our account there, or interest on the account, whatever. And this page kind of walks you through the procedure to reconcile the bank statement. So when we have the bank statement, it's reconciled to ensure orderly cash records and guard against cash losses. So to reconcile the bank statement, you need to get all your canceled checks in order. By check number. We talked about check number is this number in the top right corner here. Compare the canceled check with those listed in the statement and with stubs. Note when a check and a stub are matched, place a check mark beside the check amount on the bank statement and in the check stub. So that just lets you know that that check has been accounted for. Enter the ending balance on the bank statement. Compare deposits, enter the total of any outstanding. So this is what it's going to look like. This is an example of a bank's reconciliation statement. So you have your balance from the bank statement, any additions, so any checks that are deposits in transit, meaning they haven't been added yet to the account, but you know they're coming. And then any outstanding checks, so checks that you've written that haven't been cashed yet. So we're going to add the deposits that you've made that haven't been accounted for, and then subtract the checks that you've written that haven't been cashed. And then that will give you your adjusted bank balance. So as you can see, we started with $2,500. We added in $1,300 for what we still had coming in. We subtracted $1,500 for what was still outstanding, and that gave us our new balance. You could run into some problems while issuing checks. Typically, as long as the check is made out properly, is dated, and there are sufficient funds in the account, meaning there is money in the account to cover that check, there's going to be no problems. But there could be problems if there is a stop payment on a check, not sufficient funds for the check, or a future dated check. So looking at those three things, a stop payment on a check is issued before the check is presented for payment. This might happen usually if the check is lost or stolen or is written to the wrong recipient. So basically you're telling the bank, okay, when you see this check number come through, do not pay that check for whatever reason. Again, maybe it was lost or stolen, someone else is trying to deposit it. So you're telling the bank not to honor that check. The fee, there could be a fee that your bank throws at you in order to do that, though. Non-sufficient funds, the NSF check is called a dishonored check or a bounced check. So basically what this means is there were no funds available, or not enough funds available to honor that check. So maybe we wrote a check for $50 to another company. They went to cash it, but there was only $40 available in our account. Then that would be considered a dishonored check or a bounced check, meaning there were not funds available to honor that check. So once the bank returns the non-sufficient funds check, the effects are incorporated in the account by deducting the amount from the dishonored check. So basically what this is saying, we have to make this recording into our journal. So for example, on January 15th, a check for $600 from Rex & Company was deposited. We had a $600 check, and we took it to the bank and said, here, give me the money for this check. However, the check was returned by the bank due to insufficient funds in the Rex & Company account. So Rex & Company did not have that money available in their account. So the bank's saying, sorry, we don't have this money available for you. So we have to record that back in our journal. So what we would have done is decrease what they had owed us and increase our cash in bank. But because that money was not available, they still owe us that money. So we're debiting that account again for $600, and we're decreasing cash in bank for $600 because that deposit did not happen. And here's what it would look like as a journal recording. Okay, last couple pages here. An electronic funds transfer system. This can be done in several ways. So basically, this is ways that you could transfer funds electronically rather than always writing a check. So an electronic funds transfer provides the following benefits to business persons. You could have a direct payroll deposit. So maybe you have it set up so that your employees' accounts get deposited directly. So instead of having to write a check and cash the check and go through that whole process, they can just kind of wire that money electronically. Automated bill payment. If you're an account holder, you can give instructions to the bank to pay certain bills at certain times, so you don't have to worry about sending in a check. You could have a debit card. So this is kind of like using a check, only it's a plastic card instead. So when you pay with that plastic card, it gets money directly from your account. Phone banking, meaning you could call and over the phone have funds transferred, or internet banking. If you have a bank account, you can access it online. You can transfer funds basically from one account to another and do it that way, again, to avoid any kind of paper trail or messing with checks. So these are some of the terms we discussed in this video. Proving cash, again, that was kind of reconciling your, making sure your cash and bank account balances with the checkbook. Reconciling is the bank statement and ensuring it matches your checkbook balance. And then electronic funds transfer allows you to transfer amounts quickly and easily without exchange of checks. And that concludes our video for section 10.